Just a word or two. Herb Taylor from the Federal Reserve Bank of Philadelphia is on the GIC board and has been active in GIC for some time. And Mike Bryan is a member of GIC, and both have traveled with the Global Interdependence Center, both in the U.S. and out of the U.S. And just a note, sometimes the Global Interdependence Center does a few things quietly, and in one particular case, Mike was involved because of his expertise in inflation measures in helping us help an emerging market nation develop a price index to solve a problem that they had. So some of the things we do are not public, but they do try to improve the lives of everyone. We're going to talk about the Federal Reserve. Susan Kalla of Forbes is going to moderate this panel, but let me just say, before we start, a little story. It came to pass that the world was going to end on Tuesday. In the beginning, people didn't believe it, but it then obviously was clearly identified the world was going to end on Tuesday. The New York Times ran the headline across the front page, and it said, "World to end next Tuesday. History of the world starts on page A26. The Wall Street Journal banner headline, "World to end next Tuesday. Market reaction mixed." Fox Business ran the story, and it said, "World to end on Tuesday, Federal Reserve's fault." So we're now going to talk about QE and inflation. Susan, your panel.
Good morning. I'm delighted to have these distinguished panelists with us today. Herb Taylor and Mike Bryan are going to speak with you today about the different steps and tools that the Fed has in front of it, and they'll help you handicap what some of the thought processes are and what may lay ahead. It's particularly important to me. I'm a fund manager, and so the capital markets react to what the Fed may and may not do every day. And sometimes they react correctly, sometimes they react incorrectly, but you don't know until after the action's already occurred. So these gentlemen will give you an idea of how difficult the decision is, how many variables are involved in the process, and really what different options we have in front of us. And we'd like to hear from the audience as well about what you think is going to happen going forward. So our first speaker will be Herb Taylor. Oh, sorry. Herb is an economist and VP and corporate secretary for the Federal Reserve in Philadelphia. He handles the affairs for the president of the bank's board as well as its members. He also speaks on the economy for groups throughout the bank's district in Pennsylvania, New Jersey, and Delaware. Mr. Taylor started as an economist in Philadelphia and at the Fed in 1981. He then led microeconomics research, focusing on monetary policy, and in 1991, he became the public affairs officer. He's a member of the National Association for Business Economics. He serves on the boards for economics in Pennsylvania, which supports economic education in the schools, and also for the Global Interdependence Center, which promotes international understanding of finance. He received his BA in economics from LaSalle University and a PhD in economics from Temple University. Without further ado, here's Herb.
Thank you very much, Susan. I appreciate that. And good morning, everyone. It's a pleasure to be here to talk on this panel about QE and inflation. I will note at the outset, as Fed speakers always do, that I am speaking for myself and not for the system, nor for any other members of the Federal Reserve System. I'll say that includes our own president in Philadelphia, Charles Plosser. As many of you know, he is quite capable of speaking for himself. And in fact, he did so this week on Tuesday at 8 a.m. in Altoona, Pennsylvania. So you might ask yourself, how did I wind up on a panel in Bermuda when my boss was speaking at 8 a.m. in Altoona? And I'll just say, whenever you get a choice, book your gig with the GIC. That's the deal. My assignment on this panel is to talk about QE, or more properly, large-scale asset purchases, also known as LSAPs. Just to get a sense of the room here, how many people in this room think that the FOMC will begin tapering the pace of its asset purchases within the next 6 months? Okay. How many people in this room think that the Fed should taper its asset purchases over the next 6 months? Great. So everybody thinks we'll do the right thing. We'll do what we should do. For myself, I think it would be prudent for the Fed to wind down its current LSAP program expeditiously and to do so in a clear and orderly way. But I realize that it is not really an open and shut case in the minds of so many of us. So I'll use my time this morning to offer one weighting of the costs and benefits of LSAPs as a starting point for our session's discussion. And I think a good place to start is with Chairman Bernanke's remarks at the 2012 Jackson Hole Conference when he discussed non-traditional policy and the policies that had been put in place since 2008, and he talked about the LSAPs in particular. The chairman at that time started out by making the case that LSAPs were of substantial benefit to economic performance. He explained that the theoretical rationale for LSAPs is grounded in portfolio balance theory, famously expounded by James Tobin and other notable monetary economists way back in the 1960s. My kids always hate when I make a reference to the 1960s. The underlying premise of the portfolio balance theory is the simple idea that investors, for a variety of reasons, consider different assets to be imperfect substitutes for one another. So changes in the available supply of an asset change its price and hence its yield. This change ripples through the financial system, affecting the prices and yields of substitutes as investors rebalance their portfolios. Thus, the Fed's large-scale asset purchases of longer-term Treasury securities and mortgage-backed securities would reduce the available supplies of these securities, thereby increasing their prices or equivalently reducing their yields. And this, in turn, would induce investors to purchase assets that they consider close substitutes, for example, AAA corporate bonds, raising their prices, reducing their yields, and so on, ultimately reducing rates across a broader array of securities. Moreover, lower long-term interest rates would also induce banks to make more loans available on better terms and at lower interest rates. And so, to the extent that stocks and bonds are substitutes, equity prices would rise as well. So lower interest rates, greater credit availability, and higher wealth would fuel more spending, particularly in the interest-sensitive sectors of the economy, and so boost both growth and employment. Very straightforward story. The chairman actually cited several empirical studies indicating that the 3 LSAPs that had been put in place and executed up until the time of his speech had a significant impact on market interest rates, reducing the yields on 10-year treasuries by approximately 100 basis points. Now, estimating the impact that the LSAPs had on the economy requires making some assumptions about the relationship between financial conditions and economic performance. The chairman took as a working assumption that the historical relationships between finance and the economy still held. Accordingly, he cited estimates from the Board of Governors macroeconomic model, indicating that the first 2 LSAPs had raised real GDP by 3% and added 2 million jobs to the economy, relative to where they would have been in the absence of the LSAPs, provided that pre-crisis relationships, again, between finance and the economy continued to hold. But, as the chairman noted, these substantial benefits would be overstated to the extent that the historical relationships I mentioned had been attenuated in the aftermath of the crisis. Moving from the benefit side to the cost side, the chairman went on to discuss the potential costs of LSAPs, and he had a substantial list. I want to highlight 2 risks and 2 costs that he emphasized. Number one, LSAPs may contribute to the potential for a, quote, imprudent reach for yield on the financial side. And number two, as LSAPs continue to expand the Fed's balance sheet, the public might lose confidence that the Fed's, and I quote now, ability to exit smoothly from its accommodative policies at the appropriate time would be compromised. So the chairman noted that either of these developments might pose a threat to financial and economic stability. Having outlined the costs and benefits of LSAPs, the chairman said that the FOMC would be deciding on the future course of LSAPs based on a cost-benefit calculus, and that given the uncertainty surrounding both the costs and the benefits in terms of concept and measurement, such non-traditional policies as LSAPs should have to clear a high hurdle before enacting them, a higher hurdle than for traditional policies. Since the chairman set out this baseline case for LSAPs last year, a lot has happened and a lot of analysis has been presented. My reading of all this is the following. One, the benefits that the current LSAP programs deliver to the economy are likely to be less substantial than historical relationships suggest. The costs that the current LSAPs may impose by inducing a reach for yield and creating uncertainty about the Fed's ability to conduct an orderly exit are significant. And so continuing the current LSAP program may very well not clear the hurdle for enacting a non-traditional policy. Accordingly, in my view, it may be wise to wind down the current LSAP program in an expeditious manner. And I'll spend a few minutes elaborating on those points. To see why LSAPs may be less beneficial to the economy and pose greater risks to stability, consider in greater detail the mechanism by which LSAPs bring down longer-term rates. Typically, we think of long-term Treasury rates as comprised of two components. The first component is the average of current and expected future short-term rates spanning the same investment horizon. If the yield on long-term Treasuries were just equal to this average, a risk-neutral investor would be indifferent between holding long-term Treasuries and holding a sequence of short-term securities over the same period. But recall from my earlier remarks that investors are not indifferent among alternative assets. They view them as only imperfect substitutes. Accordingly, there is a second component of long-term Treasury rates, the so-called term premium, the extra return that investors demand for taking the risk that the short-term rates will rise, exceeding expectations, and so the market value of longer-term securities will decline. Of course, these two components of longer-term Treasury rates cannot be observed directly, but they can be estimated, and there is broad agreement that LSAPs reduce long-term Treasury yields by pushing down on both of those components. As far as expected short rates go, of course, these are already low. The market presumes the Fed will be holding short-term rates to extraordinarily low levels for some time, both based on the Fed's observed behavior and on its forward guidance. But LSAPs can push market expectations about the future path of short rates down further in two ways. First, LSAPs can reinforce to market participants the Fed's commitment to maintaining an accommodative monetary policy. And second, as a practical matter, market participants recognize that the Fed would stop trying to ease credit conditions using LSAPs sometime before it would begin tightening credit conditions by raising short-term rates. So increasing or extending LSAPs is perceived in the marketplace as pushing off the time when short rates will begin to rise. But aside from the LSAP's impact on expected future interest rates, the LSAPs also reduce that term premium. This is just another part of the portfolio balance story. LSAPs reduce the supply of long-term Treasuries available to the marketplace, and investors could move to other assets entirely, but other assets are only imperfect substitutes. So investors also compete for the smaller supply of Treasuries by bidding up their price, accepting less compensation, a smaller term premium, for taking the interest rate risk that these securities carry. The important point I want to make is this. Estimates suggest that, at least prior to this summer's increase in interest rates, the term premium on long-term Treasuries has actually gone deep into negative territory, perhaps something on the order of 80 basis points. That means that investors have been willing to buy long-term Treasury securities, even though they expect the holding period yield on them to be considerably lower than if they had invested in a series of short-term treasuries and continuing to roll them over. The creation of a negative term premium is important for two reasons. First, it suggests that the current low interest rate environment may have created an extraordinary and potentially destabilizing reach for yield in the financial marketplace. And second, it implies LSAP's ultimate impact on the performance of the real economy may be less than expected. On the financial side, the question at hand is whether LSAPs are encouraging this reach for yield that has gone so far as to become, to use the chairman's words again, imprudent, and thereby threaten financial stability. Over the course of several speeches, Fed Governor Jerome Stein has suggested that persistently lower interest rates may be fostering a reach for yield that, while it may not threaten financial stability, it could introduce significant volatility to financial conditions. He posits a class of so-called yield-oriented investors, not individuals, but institutions, banks, pension funds, insurance companies, that put some weight on the expected holding period yield, but also put some weight on the current income that they show to their shareholders and to their accountants. When short-term rates are low, these yield-oriented institutions take a variety of measures to keep their current income up. They may take on more interest rate risk by buying longer-term assets, or they may take more credit risk by buying lower-rated securities, by increasing leverage, or in the case of banks, easing the non-price terms of credit. As these risks accumulate within the financial system, the likelihood increases that there will be some disruption that causes interest rates to spike or credit conditions to tighten. And to the extent that these institutions are funding their long-term assets with short-term liabilities, there is even the tail risk of the kind of run on these institutions that precipitated the financial crisis. But we need not go that far. As Governor Stein put it, one scenario to be worried about may be simply that a sharp increase in market-wide interest rates at an inopportune time will make it harder for us to achieve our dual mandate objectives. In short, it is plausible that LSAPs and negative term premiums foster an imprudent reach for yield that threatens financial stability, or at least heightens financial market volatility to the detriment of the economy. Leaving the risk considerations aside, let me now turn to the notion that the negative term premium implies a diminished impact for LSAPs on the real economy. Again, I hearken back to a point made by Governor Stein. In the standard macroeconomic model, the level of business investment is affected by the level of long-term interest rates. Investment in new plant or equipment or software pays out over a long period of time. So long-term interest rates represent the hurdle rate that investment projects must exceed in order for businesses to undertake them profitably. So as long-term interest rates go down, standard macroeconomic models predict that the level of business investment will rise. But when the term premium turns negative, long-term interest rates no longer represent the hurdle rate on which businesses should base their decisions about investment projects. Instead, the hurdle rate for real investment projects should be the highest rate of return that the business could earn on a financial investment alternative. And with a term premium negative, that alternative would be the sequence of current and expected future short rates. So, long-term interest rates might go down, but the increased level of investment predicted by the standard macroeconomic model may not materialize. In short, the deeper down into negative territory LSAPs push the term premium, the less impact they are likely to have on investment spending and hence on GDP and on employment. To recap, I have cited some reasons that I believe LSAP's downward pressure on the term premium may increase potentially deleterious reaches for yield and may diminish the impact of their impact on economic activity. The events of this summer and the fall demonstrate, I think, the Fed must also consider the impact of changes in the pace of LSAPs on the other component of long-term interest rates, that is to say, market participants' expectations about the future course of short-term rates. Given the Fed's uncertainty about how to best use its non-traditional policy tools, as Chairman Bernanke put it, we are still learning by doing, it is preserving its discretion over how it will modulate the pace of LSAPs over time. But in the absence of a well-articulated and credible rule linking modulation in the pace of LSAPs to observable economic variables, market participants are uncertain about the future path of LSAPs and therefore, by implication, uncertain about the future path of short-term interest rates. This heightened uncertainty can further increase volatility in long rates and asset prices and further undermine the economic performance that the Fed seeks. Put another way, in the marketplace right now, there is uncertainty on two levels: uncertainty about future economic developments and uncertainty about how the Fed will react to those developments. A firm commitment by the Fed to a well-specified state contingent or data-driven rule for modulating the pace of LSAPs would take one level of uncertainty out of that mix. Let me sum up. Recent analysis and experience suggest to me that the benefits of LSAPs for stimulating economic activity and employment may be smaller than models based on historical statistical relationships suggest. On the cost side, LSAPs may be setting the stage for financial disruptions, potentially significant enough to slow economic growth or even derail economic expansion. Presently, uncertainty about the future course of the economy is one factor holding back the economy's performance. Because the Fed is uncertain about the possible impact of modulating the pace of LSAPs and is unwilling to commit to a course of action for LSAPs, the level of uncertainty is compounded in the marketplace, and this may further undermine the achievement of our macroeconomic goals. Thus, it may be that in weighing the benefits against the costs, LSAPs do not clear that higher hurdle that they must in order to warrant enacting them in pursuit of the Fed's macroeconomic goals. And if that is so, then prudent policy might be to begin winding down the current LSAP program and do so in a simple and straightforward manner. Thanks very much.
We're going to hold the questions until the end of the panel. And so now I'd like to introduce to you Mike Bryan. He's the VP and Senior Economist for the Research Department at the Federal Reserve Bank in Atlanta. He's responsible for organizing the Atlanta Fed's monetary policy process, and he previously served as the Vice President in the Research Department for the Federal Reserve in Cleveland, where he specialized in business analysis and with an emphasis on reassuring and tracking inflation rates. He joined the Cleveland Fed as a bank examiner in 1978 and served as an economist for the Federal Reserve System's Board of Governors. He became an economic advisor in 1991 and a bank officer in 1995. In 1998, he was a visiting scholar in the Bank of Japan's Institute for Monetary and Economic Studies in Tokyo. And then in 2000, he was a visiting economist in the Swedish Bank in Stockholm. He has a bachelor's degree in business from Miami University of Ohio, and he has a master's degree in economics from Case Western University. And without further ado, here's Mike Bryan. Thank you.
Thank you. And thanks to David and GIC and others for inviting me here. It is a bit distracting to look out the window, and you know, especially if you like sunshine and blue water and sailboats and wonderful people. But I'm from Cleveland, Ohio. I'm never really comfortable unless I'm in a dark environment with a freezing rain in my face. So my tastes go more towards Altoona, Pennsylvania, but that's me. I'm responsible for helping Dennis Lockhart, the president, CEO of the Atlanta Fed, get ready for an FOMC meeting. He's an international banker. He's not an economist, and my job is to make sure that he has the information that he needs to sit at the table and make the decisions that are ultimately his. So I spend a lot of time doing economic forecasts and a variety of related things. And my personal bias is more towards Chicago school economics kind of thinking. I believe inflation is always and everywhere a monetary phenomena. I think the There are clear limits to the conduct of monetary policy. I have spent most of my academic career making fun of things like Phillips curves, and I even have a hilarious lecture on the silliness of liquidity traps. I don't make those jokes anymore. I'm kind of going through an emotional crisis as an economist. And the reason I say that is that at the end of the day, I'm an economist. Right? I don't have a great deal of business experience. I got 36 years inside some economic model that helps me make some sense about the way the world works. And if that model doesn't fit the data of the world I'm looking at, just saying the same thing over and over and over again isn't very valuable. I got to rethink the model. So I want to emphasize something here, that the views I'm about to say are not necessarily the views of the Federal Reserve Bank of Atlanta. They're not necessarily the views of anybody of importance inside the Federal Reserve System, and I'm not even sure they're my views. I'm really struggling with this right now, but I'm going to make an argument. And I'm going to show you a lot of slides, but I hope you'll find them a bit interesting. Here's one of my favorite slides that I produced about a month ago. Dennis Lockhart expects me to produce a good economic forecast. And I tell him that, well, I don't believe in economic forecasting, even though I've done it for over 30 years. And he says, well, why do I pay you? And I say, well, forecasts are all about risk management, right? I mean, I can give you a baseline forecast. I can throw it out there. But I know it's going to be wrong at some point. And the question is, am I in a position to know where the weaknesses in the forecast are? And when data, events, things turn against that forecast, do I have appropriate models to adjust and make the appropriate policy advice at that time? It's all about risk management. At the Atlanta Fed, we don't have one model that describes the economy and makes a forecast. I bring to the table every time about 14 different models. Different variations, some of which we believe in sometimes, some of which we don't believe in at some times. I remember Dennis saying, why don't you just give me the right model? And my answer is, well, they're all wrong. The question is, which one best fits the data in this particular economic circumstance? Dogma isn't going to do me any good. So here's an economic forecast. These are the midpoints of the central tendency of the FOMC for real growth. Okay, so the way you read the top left chart is, if I was in early 2009, trying to predict what would happen in 2011, the FOMC said, the median view of the FOMC said, expect a growth rate in 2011 of somewhere between 4 to 4.5%. Now, of course, that's 2 years out ahead. They've got no data, but that's what a purely model-driven forecast would have given. And then when the data starts coming in, those forecasts got revised, and when we actually started to get hard data for 2011, you see what the forecast did. And it came out to be a little less than 2%. Well under half the growth rate the economic forecasts were telling us. But okay, some bad things happened. That was just 2011. Let's think about 2012. So if I was trying to make a forecast in 2009, 2010 for 2012, the median view coming out of the FOMC was that growth would be somewhere in the neighborhood of 4 to 4.5%. Of course, that's before we have any data. And then when the data starts coming in for 2012, the forecast plunges, and it actually turned out to be considerably lower. Well, some bad things happened, and an acceleration in the growth rate of the economy is just around the corner, certainly by 2013. And when we first started forecasting growth in 2013, which was 2010, 2011, we thought growth would be in the 4 to 4.5% range. Of course, that's before we had any data. And then as the data came in, the forecast has come down, and now it looks pretty certain that the growth rate for real GDP in 2013 will be at best 2% or something lower. That's slide number 1. Let's see where the economy is going right now. So one of the things we do at the Atlanta Fed is we have a real-time tracking estimate for GDP. So we try to tell the boss what we think the economy is doing right now on the basis of the monthly indicators coming in. We try to replicate what we think the BEA does with the numbers when they make up GDP. And so what you're seeing on the bottom there are all the monthly reports as they come in, and the red line represents how we put that into a model to predict what the third quarter GDP growth rate is going to be. Now, we had been forecasting the third quarter, the second half of 2013, would be when the economy finally started to gain some traction and start to accelerate. Looks like we're getting 2%. So if the boss asks me, how's that forecast of yours doing, Mike? I'm going to say, well, it's coming in around 2% again, but next year is when it goes up to 3.5%, 4%. Here's another one of my favorite charts. So sometimes one of our forecasting techniques is to kick the economists out of the room. I kind of recommend that every now and again, and just let the data speak for itself. So these are what we call BVAR models, Bayesian vector autoregressor models. And basically, there's a little bit of judgment here, but not much. But what we do is we just throw in a bunch of data, and we've got lots of BVARs that we run. And we say, knowing nothing but what the data are now and what their historical relationships have been to GDP and what their historical relationships to each other have been, predict for me the most likely statistical step in the economy, okay? There's absolutely very little judgment applied to these things. These are kind of theoretic models. And if I was to run a statistical test a year ago at this time, and I asked, on the basis of the data and the history of the data, what do the statistics say is the most likely outcome for the economy? It gives you that dotted blue line. Okay, it's not exactly the 4% growth rate that represented kind of the consensus view of the world a little while ago, but it does show a pretty smart acceleration in growth. If I run the same statistical exercise today, which is the red dotted line, that acceleration in growth is disappearing. What the BVAR models are trying to tell us is that we've been seeing 2% for so long, that looks like normal. The cross correlations of the data don't seem to be wanting to pull you up to something that a history would have said was a more typical growth rate for the economy, maybe something you aspire to achieve. But that on the basis of the data, we're on the same growth path that we've been on since this recovery began. And I think that this raises a really important question, which I think is at the centermost of most FOMC decisions. Is what we're seeing in the economy structural? And by structural, I'm going to say related to the availability and productivity of resources, independent of any kind of monetary policy. Or is this a fundamental weakness of demand that monetary policy has yet to adequately address? That's the key issue. Central banks are in the aggregate demand management business. And if you don't believe that, then at best, they're just into the price stability management business. But that's what we do. And so the key issue is there anything for us to do? Is a 2% growth rate economy the best that this economy the U.S. economy can achieve, or have our policies in one way or another been lacking? Now, whatever your answer to that question is, whichever side you come down on, and let me guess, I'm going to guess that the vast majority of you think of it more as a structural problem than as a demand problem. I don't know that's the case, but I talk to these kind of groups a lot, and I'm going to guess that's the case. You also have to reconcile it with this chart, which is the rate of inflation. And I don't care how you measure it. We in Atlanta measure inflation in a lot of different ways. But they're all telling us the same thing. If your objective is 2% inflation rate, you aren't achieving it. So whatever theory you have about the weakness in the economy has to also explain why prices in this rather extraordinary period of monetary stimulus are still tracking significantly below what the modest 2% objective is for the central bank. All right, so how do we make an inflation forecast at the Atlanta Fed? This is a schematic I put up for the boss every now and again just to impress him that it's really complicated and he doesn't want to ask a lot of questions about it. But I'm going to suggest to you that almost all economic forecasts are made with this kind of basic structure in mind. Now, all these various channels you might shut down, give lower weight. There's a lot of different ways you can produce these forecasts. But that, by and large, represents what I would consider a basic understanding of the processes by which inflation ultimately results. And oh, by the way, at the Atlanta Fed, we have something called the Inflation Project website. And one of the features of that is that we have a dashboard, an inflation dashboard. And what it is it takes a look at these 1, 2, 3, 4, 5, 6, 7 components here that represent the key forces that drive the inflation outlook. And it shows you where the current indicators are for those various forces relative to what we would consider, what history would consider typical for an economy generating a 2% rate of inflation. Okay, so if you're inside more towards the middle of that blue area, you're in an area that consistently or over time has tended to generate inflation that was in the vicinity of 2%. As you go towards the lower end or the upper end, then some bells go off as a potential signal that one area of your inflation forecast is starting to misbehave, and you ought to look into it and see why. So one part of this economic forecast that I've traditionally made fun of, and that I think is very, very controversial, even though I think the statistics are pretty clear on it and pretty solid on it. Whether or not you can use it in any predictive way is less clear, is the so-called Phillips Curve. That is, monetary policy works by stimulating demand. Demand kind of generates production. Production tends to drive up costs. Those costs feed through into higher prices. Inflation expectations can affect retail prices almost immediately, can affect wage weights almost immediately. And this represents another key component of the inflation outlook. And I think whenever you hear policymakers, the central bankers in particular, talk about the inflation outlook, they'll probably talk about these two sides. They'll say, well, the economy's a little soft, the labor market's underperforming, so we're going to have low rates of inflation for a while, but ultimately it's going to be inflation expectations appear well anchored, and they're going to pull the rate of inflation back up to whatever we say it should be. And again, my Chicago school philosophy suggests that has to be the world works. I mean, if we think about inflation as the purchasing power of money, and you have monopoly power over money, you ought to be able to control its price. You ought to be able to. Okay, so here's what the core PCE inflation numbers have done, and here's what private forecasters have forecasted for inflation. These aren't the FOMC, but the distinction between what the FOMC is forecasting and what private forecasters are forecasting, I don't think is all that essential. And these dotted blue lines represents various vintages of inflation forecasts. And what I want to point out is they all have a tendency to smartly move back up to 2%. Why not? Or why do they do that? Because inflation expectations are well anchored. So over time, this channel has to be driving the process. But here's my problem. That anchor that we seem to be talking about, that is the bedrock that, yes, will determine that we will ultimately go to 2%, which I believe must be true over some horizon. doesn't seem to be coming true, certainly over the last 3 or 4 years. To which my question then would be, why not? There's certainly nothing in the traditional data on inflation expectations that leads me to believe that inflation expectations have moved to a lower level. Here are a couple of my favorite measures of inflation expectations. Households' longer-term inflation expectations say inflation ought to be somewhere in the 2.5% to 3% range. There's a lot of reasons why you might not trust households to predict inflation, one of which might not be an important variable to them, another one which they might not understand the concept in the way that economists pose the question. But certainly the investors in the bond market that price tips, that's the right-hand slide, they ought to be able to evaluate the risks and make relatively accurate long-term predictions about inflation. And, you know, they've waffled around a little bit, but they aren't moving. And they tell us that the longer run rate of inflation ought to be somewhere in the neighborhood of 2% or slightly higher after you adjust for various risk premia. Inflation expectations, by most measures, appear to be well anchored. Here's something else we do at the Atlanta Fed, which I think is kind of interesting, at least I do. We go out and we talk to businesses, and we have a rather sophisticated and deep a survey of business inflation expectations. These are pretty big companies, and we ask them to give us a forecast. And mostly what we ask them to do is give me probabilities. So let me apologize for those of you who are green-blue colorblind. I tried to change it last night to something else so you could distinguish between these two bars. But the bar on the right is green. What that tells you is that over the next 12 months, businesses expect inflation somewhere in the 1% to 3% range, 2%. We seem to be on target. Inflation expectations are well anchored. But if you look at the probability distribution, this isn't the distribution of their forecasts. This is the risk they assign to various outcomes. They assign a much bigger probability to inflation coming under 1% than they do inflation ending up above 3%. So in the near term, businesses are trying to tell us that over the next 12 months, if we're wrong about the cost or inflation outlook, it's going to be lower than the 2% objective. But now if I ask businesses, what do you think is going to happen over the next 5 to 10 years? That gives you the blue bars, which will be on the left. And here also they tell you, well, 2%, that seems about right to us. That's the most likely outcome. But look at the distribution of the probabilities. And here, there's a much higher probability, say businesses, that if we're wrong about the inflation outlook, it's going to be much higher than your 2% objective. This would ordinarily represent to me a significant upside inflation risk that we ought to be paying serious attention to. Businesses seem to be telling us that they're much more concerned about higher inflation than they are about lower inflation over the longer term. Why do I think they have that view? This is why. This is the Fed's balance sheet, but not seen from the asset side. It's from the liability side. Students often ask me, where does the Federal Reserve get the funds to buy all the assets that they're buying? I say, well, we print them. They say, well, you print them? And I say, well, no, not really. The Bureau of Engraving and Printing prints them. We get them from that. No, actually, that's not even true. We don't print it. We just conjure it up through electronic money, right? We just create reserves at will, and that's the blue area. Now, if you're a Chicago school type like me, and you've read everything that Irving Fisher ever wrote, and you believe that inflation is always and everywhere a monetary phenomenon, that seems like a problem. And I'm going to guess a lot of people in this room, as in my business survey, look at that and say, how the hell can the Federal Reserve keep inflation at 2% with that kind of liquidity out there in the economy? I got a problem with that view, even though I believe it with religious conviction. And that is, well, number one, a lot of that, those reserves aren't leaking out into M2. It's not spendable money. It's just sitting in bank vaults. And we have a good explanation for why all those reserves aren't becoming money. It's because there's been a breakdown in the intermediation process. And then we've got to ask the question, well, is that a structural problem, or is there just not enough demand out there for loans? If you talk to a banker, if you talk to a business, my guess is you're going to get different views on that, but that's important. But even if you look over at that which is what we would consider money, M2, the numbers have been pretty high. How high have they been? Well, let me pull out in my suite of models one model that we would use that looks mostly at money growth to predict inflation. It's a P-star model. You remember back in the day, am I the only one? But back in the day when P-star was high, I even think it made like Time magazine or something, you know, it's for the summer of P-star before it blew up in our face. But I actually still have a P-star model, which I conjure up. So this isn't the official P-star model I'm about to show you. But I'm going to guess to the extent that the official P-star model still exists, and I have no doubt it still exists somewhere in a cubicle in Washington, D.C. It'll give you a forecast that looks like that. If I ran the P-star model when QE1 began, and I asked, well, what's going to happen to the rate of inflation? That's the prediction it would have given. That's what the monetary inflation forecasts are telling us. If I ran it with the recent QE in mind, I'm sorry, the first one is QE2, the second one is QE3, that's the prediction that the P-star model would tell us. Okay, so now here's my problem. I believe inflation is always and everywhere a monetary phenomenon. I believe the large size of our balance sheet and the growth of M2 historically represents a potential threat to inflation. The problem I have with the view is, as I apply these models, I can't get them to work. Inflation seems to be moving in exactly the opposite direction that these models are predicting, and the deviation is hard to fathom. All right, so I'm going to close up, I think. Here are my takeaways, and let me again emphasize that these are my takeaways, and I feel like a lightning bolt from the conservative monetary gods is about to strike me dead. But despite the clear risk to an acceleration of inflation that comes from our, let's say, untidy balance sheet, and historical experience that says every time economists have ignored the growth rate of the money stock, they have lived to regret it. I can't get monetary models of inflation to generate anything that looks reasonable. The money growth numbers are just not giving you at all a good signal of where the inflation trend is likely to head. Number two, inflation expectations appear well anchored. Here's my speculation. They always appear well anchored. And my guess is by the time they appear to be unanchored, you've already got a problem. I don't know what confidence we can have in that. Number three, look, in my heart, I tend to believe in things like structural headwinds. I tend to believe that the natural rate of unemployment is a hell of a lot higher than the CBO or others would suggest. The problem I have with that view is if most of what's going on in the economy is structural, that means we're already probably hitting up against some barriers to production. If that was the case, you would think it would be a relatively simple thing for a central bank that is expanding the size of its balance sheet by $85 billion a month to get the rate of inflation to move a little higher. So, those are the data. I got all the models in front of me. Which one do I think best describes the data and is the one that I would recommend that President Lockhart follow, even though this is my view and not necessarily his? It looks to me like good old Keynesian insufficient aggregate demand is so large out there that the rate of inflation will continue to be below target for quite some time. And I'll leave for you the conclusion of what that means for appropriate monetary policy. Thank you.
We'd like to now open the floor up to questions, and we will direct them, you can direct them to either of the panelists. And I'd like to start with one question for Herb. Based on, well, it's actually for the audience. Herb surveyed you to find out which ones of you think that the Fed may start to taper, and how many of you think the Fed will start or should start to taper. So I'd like to re-ask that question now that you've heard from the panelists. So again, how many of you think that the Fed will taper within the next 6 months? Oh, that's a lot more. That's a lot more. So imagine it was very convincing. And then second, how many of you think that the Fed should taper within the next 6 months? Okay, we have a majority there. Okay, and then a question for Mike. Mike, can you talk to us about what you think the relationship between commodity prices and inflation are, and how we should think about that?
So not surprisingly, I spend a lot of time thinking about this question, and you have to. The first thing you have to think about is, well, what's motivating the commodity price increase? Is it some sort of a supply shock, in which case you get kind of, and it's a rather simple arithmetic thing for us to go through and see how important is this commodity as an input, what kind of an impact will it have, what kind of offsets are we likely to see in production. And then kind of project out. These tend to be one-time spikes, and I have a tendency to want to subtract them out of the price index because I think they're somewhat of a distraction. Energy is being a perfect example. Since the Federal Reserve doesn't control production of oil, for example, I tend to think of these things as a bit beyond the power of the central bank to reasonably control, and in any event, they tend to be the passing phenomenon. On the other hand, you can have a commodity price acceleration through standard Phillips Curve channels. Right? You can have an economy that's tending to overheat and driving up commodity prices. Right? That would be fundamentally different. That would be a demand-driven thing that the central bank could actually be causing. So how I think about commodity prices and inflation and what it means for the forecast I might make depends upon how I answer that question. Let me say that one of the things we do with our business inflation survey is we always ask special questions every month. And the reason we do that is we're trying to figure out how businesses make pricing decisions. I mean, they're price setters in the first instance after all. And we don't really understand all the forces that motivate that. Now, one question we asked them not too long ago, and we wrote about it on our blog called Macro Blog, is I randomly gave half the members of our business panel a question: if commodity prices fall, what will you do? And then the other half randomly got a question that said, if commodity prices rise by X%, what are you likely to do? And the businesses told us, the ones that got the price increase told us that they would pass it on to their customers. And the price decrease people told us they'd expand their margins. They wouldn't pass the price decrease down to their customers. And we thought that was kind of interesting, and we went back and we looked at the data, and we saw it in the data that there seems to be asymmetric responses to commodity prices, which we're now building into our models, which is when you get a commodity price boom or pop, it tends to influence the aggregate price statistics either for a short period of time or for a persistent period of time, depending upon the nature, but it pushes them right up. But the opposite is not true. If you give me a scenario that energy price or commodity prices are about to fall because of China or whatever the event might be, We tend to see that in widening margins, and I wouldn't predict any significant impact on aggregate inflation as we currently measure it.
So I'll just talk loud. Thank you. This is a question for Mike, and with regard to the modeling, have you included the doubling of the global labor force that really took place over the past decade and a half, if not a bit longer, in terms of how this has essentially had a very dampening effect on labor costs?
The short answer to your question is no. But there are some people here from the Federal Reserve Bank of Dallas who have done a lot of work in this area, and I'm sure they have, I'm going to guess they have a fairly strong opinion on this and probably very supportive of where I think you were headed for this. I mean, my view is a bit different, so maybe Dallas would like to respond, but my view is global demands for labor are important for a variety of reasons, but I don't see them as being especially important for domestic inflation. The Federal Reserve has monopoly power over money, and we ought to be able to set the price of that money at any level we want, whether there's a lot of people in the global economy or not very many people in the global economy. I can think of some real economic consequences from a really big global pool of unemployed workers or a shift in the structure of the labor force. But for my models of U.S. inflation forecasting, I wouldn't give them much weight.
I have a question about lending. It sounds like with the slowdown, like with the growth of monetary supply, but that not really trickling through to inflation. Where is the bust there? Is it in the housing market? Is it in bank lending to consumers? Like, why is there so little lending activity when the Fed expected that lower interest rates would actually be stimulative to that activity?
Is this for me or Herb? Because I really think Herb wants to answer this question.
Oh, I'm sorry, I couldn't hear.
Go ahead.
So the question is, why isn't the stimulus doing more?
Why is it not getting repeated through the economy? Is it banks not lending? Is it consumers not borrowing?
Well, now, all kidding aside, maybe Herb would like to answer this question, but let me say that I think. The lightning didn't strike me the first time. It looks like a sunny day out there, but I know as soon as I step out, it's going to hit me. If my boss asked me that question, the answer I'd give him would be that there seems to be an enormous appetite for liquidity still. And so while it appears that you're creating a hell of a lot of liquidity that ought to be generating a lot of money, and in fact in the M2 aggregates it does seem to be, the demand for that liquidity, the demand for that broader money as well, seems to be keeping apace. Why? I'm going to guess it has something to do with living in a zero interest rate environment. Do you have a model that explains that? Yeah, it's called the liquidity trap. Do you believe in liquidity traps? No, of course I don't. Seems to fit the data pretty well, though.
Herb, you want to take a shot at it?
I'll just add one point. I think Ed made the point in the first panel. You know, in business cycles, traditionally, firms anticipate a growth in demand, and so hire and invest accordingly. And in this particular environment, the uncertainties are such, and the depth of the recession and the complications of financial crisis were such that, I think as Ed said, instead of anticipating demand, they're waiting for demand. So I think there's a huge pent-up supply of liquidity out there that there's little demand for, simply because, to put it another way, there's no demand for anticipatory activity on the part of businesses out there. So they sit on cash.
Yeah, hi. I kind of struggle with the aggregate demand questions that you guys have brought up, and the whole QE and interest rate rises. But from a 60,000-foot view, I believe the total debt to GDP is still around 350%. I think it's either gone up or stayed the same over the last 5 years. And to me, it seems like we've really just played an interest expense shell game, moving interest expense from the private sector, the deleveraging, to the public sector. And the fact of the matter is that the private debt is anchored to treasuries, and rollover costs and costs to the private economy would go up as the treasury rates go up. So it seems to me that without any real deleveraging and problems with aggregate demand, that the patient's still on the operating table, and everybody seems to be so ebullient about the future. I just don't see where that transmission is right now. And I just was wondering, you guys, I haven't researched this question, but is the aggregate debt situation still that bad, and is this fairly accurate as far as interest expense on moving it from the costs of private debt, which is more expensive than the Fed has to pay, or the Treasury has to pay?
This is a ratio of total debt, so public and private.
I was talking about the total debt in the economy relative to the size of the economy.
Right. So the denominator is private, but the numerator is all debt. Right? And I think that goes to Kathleen's point earlier about the deleveraging process. Right. So the private sector deleveraged. Meanwhile, the public sector was expanding its balance sheet, and so not deleveraging and trying to keep the economy afloat, which was, I agree, a good strategy. The question is whether, as you say, we're still on the operating table. For policymakers, the question is when can the government safely begin to deleverage without undermining the path of the economy? And that's, I think, one of the questions that surfaces when people talk about QE. To some extent, your comment about a shell game suggests that it doesn't really matter whether the Fed buys that debt or not. It's the fiscal policy side of things that matters. It matters that the government continues to spend. If we happen to convert it into reserves that park in banks because nobody on the private sector side wants the money yet, that doesn't really matter. The question is, will the public policy be such that that they continue to delay their deleveraging to support an economy? So that's a judgment call. I personally don't think QE, that shell game of moving federal securities onto the Fed's balance sheet, my comments were basically intended to say, I don't think that contributes at the margin to economic growth enough to justify continuing to do so. And among the reasons we may not want to do so is the uncertainty about what that $3 trillion in reserves may mean down the road once the economy gets rolling. The more of that can pile up, if it does have inflationary implications, if the Chicago guys were right after all, then there's that risk.
David?
Herb and Mike, if this audience gave the guidance to the Fed and it said, let's stop tapering, and the Fed has indicated a direction to get to that at some near-term time. If the policy is to get the unemployment rate to 6.5 and falling, it's higher, and the policy is to target 2% inflation and permit it to get to 2.5 before acting against it, and as Mike showed, it's lower and trending down. And those targets, guidance, are the best that the market agents have from the Fed. And you stop tapering. how do you, the Bullard question, defend the inflation target from below and reduce employment to the employment target, which is currently above? Taper, schmaper, some other aper. What is the mechanism to do it? Is there a mechanism to do it? Or do you abandon the target?
Yeah, so, David, I puzzle over that a lot. So here's the question. I can imagine my boss saying, let's say we're going to taper, and I got no reason to believe we will or we won't. I'm not going to take a stand on that, but he's going to ask this question, and my first response to him would be, why, and how are you going to communicate that to the world in a credible way? Now, if you really believe that the economic outlook at this time is for real, we're going to start to see some stronger growth numbers, and maybe we're already seeing them. I mean, the industrial production numbers looked improved. ISM data looks good. Most of our data sources have been shut down because of the government shutdown, but I'm going to guess that they're really coming in gangbusters right now. So if you can credibly make the case that this time it is in fact for real, then I got a lot of models that will say you don't have to worry about the inflation being below, down around 1 to 1.5%, and those things ought to pick up rather smartly if we're talking about a 2.5%, 3%, 3.5%, 4% growth rate. And that's what you want to see. But my question is, at what point do you have enough evidence that that is in fact the world you live in? And if you can't credibly commit to that, what sort of problems does that give you down the road? That's hard.
So I would just add that this issue of stating a rule about tapering and then ultimately ending QE, I think the argument that there are different ways to argue the rationale for that. What I was trying to argue is that there's some financial stability issues at stake here. So aside from the impact on the economy, in the near term, there's this issue about what that growing pile of debt on the Fed's balance sheet and the accompanying interest rate effects will have down the road in the event of a situation. So I don't think that you put a rule in place that says we are tapering based on where the unemployment rate goes or where the GDP growth rate goes, because we think that QE is a tool for fine-tuning where unemployment is going or fine-tuning where real growth is going. In fact, I think the discussion today points to how little fine-tuning we can really competently do. I think that tapering is really, would have to come if the Fed, and I'm not saying the Fed should, if the Fed were to say, we think at the margin QE is not having substantive effect on unemployment, is not having substantive effect on real growth, and therefore the attendant risks are no longer worth taking. So, for example, I refer to Governor Stein's comments the other day again. He suggested tying tapering to changes in the unemployment rate. Every time it goes down by a tenth, we take out X billion dollars in purchases. And there's a case where you will know when the end will come, right, depending on how the unemployment rate goes. But it's not because we're fine-tuning the unemployment rate. It's because we want to get out of QE.
So let me follow up on that. So that requires a communication. And it sounds like I'm judging this, and I really am, but I want to say I'm not. So let's think about that communications for a second. You have to credibly tell the world that what's going on here is that the efficacy isn't there and the costs are high. They're going to expect you to demonstrate that, why is it you think the efficacy is not there? What new models do you have that says that this thing isn't working, when before all your models, or at least the majority, the central tendency of these models is that it does have a positive influence. And the second is, where is your evidence of all these risks, these these imbalances that are being generated. Now, you touched on a few of them, and I think those are really important. But I touched on one that I really have serious questions about. I mean, I'm going to guess that most people, when they talk about the cost of a very large Fed balance sheet, part of it is kind of the wedges you're creating in certain markets that's being potentially disruptive and could cause some problems down the road. But my guess is most of you are worried about inflation. And I don't know what evidence I could bring to the table to credibly say that this is a huge risk, other than to repeat the age-old adage, which I believe in, that inflation is always and everywhere a monetary phenomenon. But at the end of that religion, I got very little evidence.
This question.
We have time for one more question.
This question is for Mike, and it's to do with what you said about structured money not working. And I just wanted to know if you felt that central banks' fiscal policies have to start lending, get involved. It seems like everybody's on the sidelines waiting for signs, but you said the structured money's not working. How would you go about engaging it?
Oh boy, I'm not sure I said it wasn't working. What I think I meant to argue, and I reserve the right to change my mind after a drink or two this evening, is that it didn't seem to be doing quite enough. That we didn't seem to be reaching these thresholds that I would consider to be evidence that there was a growing problem from the current program of LSAP. If you're asking me, would monetary policy be easier if you were getting some support through the fiscal authority? The chairman has been very clear that he thinks that's the case. And absolutely, especially if you believe the boogeyman story I just told about things like liquidity traps and what happens to monetary policy when interest rates hit zero. We think quantitative easing is kind of a shadow alternative to an interest rate target. But the fact is there's what ought to be and what actually comes out in practice, and it might very well be that Keynes had something when he said at this point it's the fiscal authority that has to take the lead. However, let me emphasize, and this I want to emphasize over and over again because I'm on tape and I got a young family I got to support, it is that the decisions about how to use the fiscal, the balance sheet of the people is between them and their elected officials, and certainly not me at the Federal Reserve as a staff economist.
Did you enjoy it? Mike, Herb, Susan, thank you very much. A wonderful panel, and of course these are only your views, and we will ensure that that is portrayed when we put them on the website and tell the entire world. Thank you very much for an enlightening panel. We will go immediately to the session, which is our lunch keynote. George, Paul, and right after this, we will then go to lunch. And George will close the session, and we'll go to lunch. Where is lunch? In the gazebo room, wherever that is. First, we'll hear from Paul. George, Paul.
Keynote speaker for today, a long-term board member at GIC and founder of the Global Society of Fellows at GIC, an organization endowed and funded by Paul with ultimate goal to create and disseminate original research on a timely economic topics, research which is produced by a unique way with a collaboration of academics and practitioners. And we have seen the great outcome of those research projects that have been executed in the last 2 years with a great publicity for GIC and the individuals that perform research. I wish I had plenty of time to introduce the accomplishments, Paul's accomplishments, but very briefly, Paul served for many years as partner at PIMCO, And he was really involved with the markets, but what distinguishes him from others is his intellectual pursuits. He is a devoted Keynesian, admired by Keynesian economists, and he has coined various terms, including the Minsky moment and the shadow banking banking system, I'm sorry. Paul nowadays works, I guess, on fishing, his fishing skills, but at the same time he's involved with many non-profit boards. One of them is with GIC, and we are very happy to have him with us today. Just a couple of months ago, he gave an interview to Goldman Sachs. His interview was written up in one of the commentaries of Goldman Sachs, and he talked about the economy. He talked about the bond market, and his favorite topic, I think, based on my experience with him, is liquidity trap. Please welcome Paul, who is going to talk about similar topics.
Thank you very much. I'm going to be down here. It's much easier for me to talk to you if I can actually see you. I thoroughly enjoyed this morning. And I especially enjoyed the session that was just completed. It's the first time I've actually heard Mike speak before. I've heard Herb speak a number of times because he's actually on our GIC board. It was absolutely fantastic. And the honesty and the open-mindedness to reality was incredibly refreshing. I'd like to see it more often in both the scholarly arena, the money management arena, and the public policy making arena of owning our priors, including owning our models, but also understanding that reality matters. That reality matters. And I think I can sum up your speech in one phrase as a kickoff to my speech. If you observe a bartender and he has systematically cut the price of beer 50 cents a glass to $0, and yet he still has no customers, what might be the problem? Your profession has told you that if I cut the price, I will have more customers. And one day you cut the price to $0 and you're selling absolutely no beer. You say, well, I wish I could cut it to a negative price. I could pay these people to drink. Maybe they would drink, but I can't go negative on the price of beer. Might it make sense for you to entertain the possibility, just as a thought exercise, that perhaps your bar has been moved to either a Baptist church basement or an AA meeting? Because if either one of those are true, then you're no longer perplexed. You're no longer in a conundrum. You are simply in a liquidity trap. Theoretically, in the economics profession, we were never supposed to have a liquidity trap again in our lifetime. We were never supposed to have a fat tail of a Great Depression. Indeed, right before the Minsky moment of 2007 and 2008, the academic profession, the money management profession, and the policy-making profession were basking in the concept of the great moderation. The great moderation was the practicing religion right before the financial crisis. The Great Moderation, defined as simply few recessions, and when they did happen, shallow and not long-lasting, low inflation and low volatility. Sometimes shorthand called the Goldilocks economy. And in the Goldilocks economy, you could easily fine-tune aggregate demand by tweaking the Fed funds rate, changing your price of beer. If it seemed to be a little bit too rowdy, you'd add $1 to the price of a glass. If things, you'd have happy hour pricing. It was a really simple type of world. And we valued it in all assets. And here, I will venture into my Minsky land. We use the value of such assets as an appropriate measure for lending money. I just described, in a shorthand way, the housing sector bubble, but not just the housing sector bubble, which was irrational valuation validated by irrational bankers, but essentially our economy at large. And the private sector became infected with hubris, but the policy-making sector did as well. Both sectors ignored Hyman Minsky's financial instability hypothesis, which is a mouthful, but is really very simple, which is that economic activity, the course of human endeavor, is inherently given endogenously to swings from irrational exuberance to irrational gloom. Stability is not an inherent sustainable exercise. Note each of those words. That is the financial instability hypothesis. If we could have stability and didn't change our behavior in the face of stability, then stability could last. But first I would have to repeal human nature. Humans respond to stability by increasing their risk appetite. And the longer their increased risk appetite pays off, the more they will increase their risk appetite. Therefore, seeming stability is but seeming for the simple reason we respond to it with risk-seeking behavior that ultimately undermines it. I just articulated the antithesis of the Chicago school that markets are always and everywhere efficient. They're not! Because human beings inherently are guided most fundamentally by fear of a repeat of the most nasty thing that's happened in their life. And the farther in time they get away from the nasty, the more they minimize the risk or the probability of a repeat of the nasty. So therefore, my opening thesis with this preamble is simple, is normal is not stable. Because stability is inherently undermining of itself, because it leads to either increases in risk that ex post prove to be irrational, or increases in risk aversion that ex post become a liquidity trap. Let me give you a quick sidebar understanding and get off the pointy head, nerd, wonky pulpit. Has anybody, I think we can ask for a confession on this one, has anybody ever gotten pulled over and gotten a ticket for driving your motor vehicle too fast? We may even have a majority here. George, have you ever, George raised his hand too. Okay, the embarrassment's over. You pulled over to the side of the road. Guy's written you up. You get back on the interstate. What do you do repeatedly for the next hour driving to your destination?
Right.
You look at the speedometer, right? Every 5 seconds, your eyeballs look at the speedometer. Because you just had something bad happen, right? You were loose in your risk management. You got pulled over and you got a ticket. For the first hour, your eyeballs are glazing at the speedometer. You actually don't get a second ticket in the first hour. The odds of you getting a second ticket in the first hour are approximately 0. And with time from that nasty, embarrassing episode, you regain your confidence. Sort of. The next day, you're not looking at the speedometer every 5 minutes, but you're cognizant that it happened. The next week, you're still cognizant that it's happened. The next month, you're still cognizant. But your diligence with respect to risk management asymptotically goes to 0. And 2 years later, guess what? Stability. 2 years of not being pulled over for exceeding the speed limit will beguile you into believing that you're invincible. That's called human nature. And by the way, we as a society recognize that and how we order our regulation of driving, not just in the matter of speeding, but all sorts of other behaviors behind the wheel. The reason I use that episode is to explain in a very humanistic way of what happened that created the Minsky moment and what's happened in the last 6 years. To me, the most surprising thing in the last 6 years, and actually I think I talked about this in the article, it was actually a debate with Marty Feldstein that Goldman staged. I mentioned there, the things that surprised me the most is how reluctant the economics profession has been willing to consider the concept of a liquidity trap. A liquidity trap, easily defined, for me anyway, is after a Minsky moment, or put differently, after stuff has hit the oscillator big time, and the private sector goes into either involuntary or voluntary delevering. Prior to your Minsky moment, you will have excessive drinking regardless of the price of beer. Post the Minsky moment, you have no drinking when beer is zero, because the hangover lasts a long, long time. Now, it doesn't mean that the Fed should be puritanical about the whole thing and say you deserve it. There are certain wings of the economics profession, particularly those associated with Chicago, also those associated with Mr. Mellon when he was Treasury Secretary in 1931, who simply believe you get what you deserve. That we deserve a Great Depression as just recompense for our sins. I hear this occasionally from the Tea Party, too. However, we are blessed that Mr. Bernanke and the Federal Reserve didn't take a Calvinist approach to dealing with what happened in 2007, 2008, and 2009. The Fed did cut the price of beer to zero. And the party is still exceedingly subdued. One of the key reasons is because we've had, at the fiscal policy side, literally until a few minutes ago, I suppose, this notion that when the economy is in the Great Recession, when the economy is in a liquidity trap, that the government sector should tighten up its belt just like the private sector is doing. Clearly, we have an ignorance with respect to the paradox of thrift in fiscal policy. So we got disastrously bad fiscal policy in the last couple of years. We've cut the deficit in half in the last 3 years. That is something that the president brags about. Politically, I would certainly urge him to do so, but economically, that's a disaster. We didn't need to do that, but we did. So the economy is still limping along. Liquidity trap analogy is right. And I will switch analogies from the bartender at the Baptist church to a different one. This is a new one for me. I'm going to see if this is going to work. The Fed is not forever going to be disappointed with the results of the munificent supply of its product at a low price. Because the Fed really isn't a bartender in an AA meeting. The Fed is a hot dog vendor at an Overeaters Anonymous convention. People at an Overeaters Anonymous convention do not swear to never eat another hot dog one day at a time. They simply are learning to manage their eating behavior. And it is true that in the early stages of losing that excess 40 pounds around the waist, that probably is not a really good idea to be dropping by the hot dog vendor. The hot dog vendor standing over there. $2 for a quarter. Doesn't get very many customers. But as we normalize the weight of the people at the Overeaters Anonymous, otherwise known as over-indebted private sector borrowers, things will change. Things will change. And it's happening. It's happening. It's happening in the household sector, and it's happening in houses. There is a natural curative process that unfolds with time. And actually, those who've heard me speak in the last year know that I'm pretty optimistic about the state of the United States outlook. I don't bemoan that it's going to be weaker than it was 10 years ago. I don't look at 10 years ago as the old normal, or 15, or 20 years ago. It was reality, but I wouldn't call it necessarily healthy. It was the behavior that led to the extra 40 pounds around your waistline. Longing for the degree of calories that led to the extra 40 pounds doesn't seem to be a prudent benchmark of measuring whether or not you're eating good cooking now. And actually, what I think is unfolding in the housing sector is just returning to being, in many respects, driven by affordability, based upon the alternative to owning a house being renting a house, and demographics. So actually, I'm reasonably positive about the economy, assuming that fiscal policy is not an unmitigated disaster. I grant that is an assumption, but I'm reasonably positive about the economy moving forward for the simple reason time does heal. But during that healing process, things will look very punk for a long time. Just like you will be the slow driver the day after you get the speeding ticket. That's just reality. To say something's wrong, no, nothing's wrong at all. That's just the way the beast works. Now, I want to use my last 5 minutes after I've noted the degree of optimism to say that it could be better. If policymakers, and here not just Fed policy, but fiscal policy, but policymakers broadly speaking, would just simply accept the conclusion that Mike offered, maybe we have a shortage of aggregate demand, that maybe the monitor's model of inflation is wrong in the liquidity trap, maybe the Phillips curve does exist, and maybe structural arguments for the high unemployment don't make sense, because if they did, we would have incipient inflation in sectors of our economy, and we don't. If we just accepted that A, we're in a liquidity trap, and B, the Phillips curve exists, and drew the logical C conclusion we have a deficiency of aggregate demand, you can understand why the Fed's doing what they're doing. You can understand why Janet is going to be doing what she's doing, which is more of the same. We have a liquidity trap. We're on the wrong point of the Phillips curve, and the way to move it is more aggregate demand and time. And time. So that's the overall conclusion I want to give you. I know that they mentioned something about Rudy Dornbush in my title, and I want to use my last couple minutes to tell you why I'm no longer talking all that much about the Minsky moment, but I'm talking about Dornbush's destination. think everyone kind of knows what the Minsky moment is now. I actually coined that in 1998. So it was a long time before it became part of the lexicon. But I think it's important to take an insight from Professor Dornbush from an article he wrote in 1976 to help sort through this nonsense I hear all the time about how financial markets are not priced to fundamentals, but have artificial valuation based upon QE and forward guidance, and that they are Fed-determined markets that have detached from fundamentals. And therefore that we as analysts and investment managers really need to get back to fundamentals, and therefore we need to get the Fed out of the equation so as that fundamental analysis and fundamentally driven valuation matters again. Has anybody heard that argument? Has anybody made that argument? Maybe moving beyond preaching to meddling in your affairs. But I don't look at what's going on right now as artificial. Once we had the Minsky moment and entered a liquidity trap, you needed a policy response to prevent a depression. The policy response was called unconventional, unorthodox monetary policy. It was unorthodox and unconventional relative to my lifetime because we hadn't been in a liquidity trap before. So if it hadn't been unorthodox and unconventional, I would have been deeply concerned. And those who were arguing against unorthodox and unconventional were in denial with respect to the liquidity trap. So the first and foremost, Ben gets a huge amount of credit for saying, this is different. We did just get pulled over, pal. We're in a liquidity trap. However, it was always unreasonable, here I may be a little bit critical of Ben, to expect that the zero rate policy, as well as the forward guidance, which helps keep down expected short rates, and then QE, which reduces the term premium. Herb, you did a fantastic job in laying out the analytics of the whole deal. All of that response should be felt on Wall Street first. This gets back to Rudy. Rudy developed something called the model of rational overshooting. That markets can be driven by policy to levels that are either above or below their long-term fundamental value, but that does not mean they're in a bubble. It means they're in a rational overshoot or undershoot. And I really want to leave you with the notion that overshooting doesn't imply a bubble necessarily. It might. We had a bubble in property market. It was not tied to anything that was rational. But long-term interest rates, or put differently, long-term bond prices, as well as equity prices, are not artificially, in my viewpoint, priced right now. They are priced relative to what Fed policy is trying to accomplish. What Fed policy is trying to accomplish is to get us out of a liquidity trap. And that takes time for a very simple reason. And Rudy nailed it on international things. Goods prices, balance sheets move more slowly than interest rates, or currencies, or perhaps even commodities once you turn them into an asset class. And the example Rudy laid out in '76 is why are currencies so incredibly volatile? And the answer is really simple. Suppose a country gets hit with a shock, an aggregate demand shock, and goes into a deep recession. the first impulse is to reduce interest rates, right? That's pretty conventional. However, if you're the only dude reducing interest rates, what does that logically imply for your currency? That it's going to go down. And it ain't going down to long-term fair value. It's going to go down to the point that it is so dirt cheap somebody wants to buy it. Until somebody wants to buy it. That matters hugely. So therefore, it's particularly when you're involved in emerging market space, when an emerging market gets hit with a shock and cuts interest rates and the currency starts going down, always resist the urge to buy it on the way down. Because ultimately, easier monetary policy in that country and a lower currency will improve growth. Once goods prices and patterns of trade have adjusted, but in the short run, the currency will become cheap. It will be a negative bubble. It will be a negative bubble. And Rudy pointed out that's rational. Simply rational. The world's got to work that way. Because if you're going to reduce your interest rates to nothing versus everybody else, your currency is going to have to go down to a point where people don't care of what your interest rate is because they think it's undervalued. With me here? A rational overshoot. It's not a negative bubble. It's a rational overshoot. Very powerful paradigm. It's actually hugely important for money managers is don't believe that simply because something is quote-unquote fair relative to the long-term value, it should be bought or sold. It depends upon where it is in context of other variables in policy. Where we are right now, yes, stocks are overvalued relative to the fundamentals of the economy. They've gone up for the last 5 years as people have been saying they've been on a sugar high. It's not a sugar high. The Fed is trying to reflate asset prices, including equities and home prices. Because equity, whether it's the stock market or equity in your home, is the one asset that doesn't have an offsetting liability. It is free money. Essentially, you get out of a liquidity trap by reflating equity values because it endogenously delevers the economic system. It takes time, and it has the disgusting aspect of making the rich richer and the poor poorer, and the young richer and the old poor. It has lots of distributional impacts to it that I find unsavory as a progressive liberal. But as a practical matter, that is what the Fed is doing. Now, any time in the last 3 years you've looked at the stock market and said, the stock market is overvalued to current economic fundamentals, it's just a sugar high based upon the Fed and I should sell, has been a really, really bad idea. And there's a very simple reason it's been a really, really bad idea. The Fed funds rate at nothing is pegged. It's not artificial. The Fed has the fiat power to peg it there. And everything else has got to adjust. Financial assets adjust first, and the adjustment of financial assets endogenously brings about economic outcomes that produce the escape from the liquidity trap, and that's called the Dornbusch destination. Larry Summers calls it escape velocity. I like Rudy's destination as a better outcome. So don't be beguiled into believing that everything is artificial because of what the Fed is or isn't doing. Now, I actually have opinions about how the Fed should tweak what it's doing or not tweak what it's doing. But the important thing is to understand the Fed itself knows that 0 is the wrong interest rate for the long run. It also knows that QE is the wrong policy for the long run because it plans to be successful in the short run with these policies, and success will breed the exit strategy both from short-term interest rates at 0 and from QE. It will not be an autonomous decision. This is just wrong. We should quit doing this. It will be the positive fruits of these policies that will produce the exit. And the positive fruits are higher valuation for assets that endogenously delever the system. So I thank you for your wonderful setup for me. This was great, and I appreciate the opportunity.
Paul McCulley, animated and thought-provoking. I think we might have just time for one question and only one, because we ran over this session, but just one question, very short one, before we run. Yes, go ahead.
You can be short question, but I can't have a short answer.
I don't mean to be disagreeable, but why has that never worked in the past? It didn't work in 1932, it didn't work in 1937 when they doubled up on it, and it didn't work after World War II. Why not just cut regulation, cut taxes, and stimulate demand that way?
I'll give you a short answer to that, and then you're not going to talk about it later. Cutting the regulation on the hot dog vendor at an Overeaters Anonymous convention is not going to sell more hot dogs. We don't have a supply side problem, we have a demand side problem. So incentivizing more supply when you have a shortage of demand doesn't really work. And actually, I do have to respond longer. In 1931, Mr. Mellon made a colossal mistake, did not recognize the paradox of thrift. We didn't try Keynes in 1931. We tried it between 1933 and 1937. We went off the damn gold standard, and Mr. Roosevelt had an incredibly experimental program that would, in the fullness of time, in retrospect, be called Keynesian, and it worked beautifully. And what happened in 1937 was an exit from proper Keynesian policies. It wasn't an attempt to double up on them, it was to remove them and promptly put us back into another recession. Between the years of 1933 and 1937, 4 years, the unemployment rate in America dropped from 25 to 15%. We dropped 10 full percentage points on the unemployment rate under Roosevelt, post Mr. Mellon's debacle of 1931. I actually have a few viewpoints on this. Thanks, everybody. Appreciate it.
Thank you, and thank you, Paul. And enjoy lunch, and I want to remind everybody we are returning here in this room at 1:30 and resume the program. Thank you.